Don't clap yet, dude. Don't clap yet. I have a talk. Well, I guess I'll do this. Can everyone hear me okay? Do I need this thing? Do I need this?
Yes. Yeah.
I do? Okay. Fantastic. So, yeah, don't clap. I have a talk that kind of looks, it's an appropriate weather day for the talk that I have. Because we really can't see a whole hell of a lot of what's going on right now. So if anything I say approximates an answer today, you misheard me. I got a bunch of questions today, nothing more than that. I'll stop now and say anything that I do say are my opinions and my opinions alone. They don't necessarily reflect the Federal Reserve System or the Federal Reserve Bank of Atlanta. It'd be nice if they did, though. Okay, so we had a lot of questions at the end of 2024, and it's not getting any better. What do I mean by this? Well, this is real GDP growth and professionals' forecasts for 2024 and then 2025. The forecasts are in green. 2024 was a really strong year for growth, 2.5%. Much stronger than what we thought we needed to see in 2024 when we started off the year. So this time back in 2024, we were projecting something around 1.75%. We learned over the course of the year, over the course of the last couple of years, that there were a couple of factors sort of buffeting the economy and creating uncertainty when it comes to what we're thinking about for the sort of long-run, normal, steady-state trajectory of the economy. One of those things was a dramatic surge in immigration over the past maybe 3 years or so. So you can think about that in the context of the economic outlook as a surge in population growth. Well, the increase in population brings about an increase in labor supply, which is wonderful. It also brings about an increase in aggregate demand, which shows up in GDP growth. So when I was thinking at the beginning of last year that I needed to see 1.75%, and that wouldn't put any sort of further upward pressure on inflation, and that would lead to the unemployment rate kind of settling back down into a sort of more normal level, what we got was 2.5, and we still got those other things for the most part, I think. The other things that we saw in 2024 is this a dramatic increase in consumption. Again, some of that's tied to this population growth from immigration. The other is sort of, I'm kind of left scratching my head. Because by all indications that we can sort of get at in both the aggregate data and disaggregated micro data, it looks like consumers have completely exhausted this sort of excess saving or any sort of additional support they got during the pandemic. Like the sort of revenge spending stuff's over, the trips to Italy for the most part are over, like that's all done. But consumption growth was still strong last year. And non-residential fixed investment growth, the CapEx, that too was pretty solid for the year. Forecasters kind of expect more or less the same thing to happen this year.
That is real?
Yes, they're all inflation adjusted. Yep. So GDP growth right around 2, still pretty good. Consumption growth right around 2, still pretty good. And business fixed investment, that's actually maybe a skosh higher than it was last year. So, like if I stopped here, like we got good news. I'm not going to. I want to point this out now. Oh, there's somebody's wallet's on the floor there. I don't know. Sure. I'm going to come back to this at the end of the talk. I just kind of want you guys to have this. I want everybody to have this in the back of their heads. This is the distribution of the long-run Fed funds rate projections from FOMC participants. So this is what they think. This is the dispersion or uncertainty among committee members for where they think the sort of normal or neutral rate, Fed funds rate is, and that's nominal. Okay, so kind of where is that interest rate that the economy would land at when everything's kind of hunky-dory, when we're at full employment and price stability? Okay, that's about as wide of a spread as I've ever seen. Okay, so we're already starting off on a bad, well, If we want certainty, we're already starting off on a bad foot. But this is going to come into play, I think, as we move throughout 2025 and then through the next year as well. So when I say all I have is questions, really all I have is questions. I got a bowl of confusion. I got some known unknowns. So it's not Knightian uncertainty. Like I at least know what I don't know, but I don't know much about these things. So we have the potential for this surge in productivity growth. I'm going to point out some of that stuff. We have a whole lot of questions over what's going to happen with fiscal policy, on immigration. Yeah, I still have questions on tariffs, and if anybody feels like they have clarity, now's the time to raise your hand and tell me what the hell's going on. All right, perfect. We're in the same boat. And then, especially after this morning's inflation report, I got questions about that too. So let's cover some of these known unknowns. Let's start with productivity growth. Productivity growth underpins the sort of long-run trajectory of economic growth, increases standards of living, all that wonderful stuff. One of the things we saw during the pandemic, and in fact at the outset, was this sort of, the way we measure productivity growth is very simply real output per hour worked in the economy. Okay? It was on this nice, pretty slow, stable upward trajectory prior to the pandemic. And then it kind of blew out at the beginning of the pandemic. We got this surge, what looked like a surge in productivity growth, but it never really converged back completely to its pre-pandemic trend. All right, we still have this little elevated jump. Now, some of this is just math at the beginning of the pandemic. When we're thinking about the folks that were that lost their jobs versus those that were able to keep their jobs, a lot of the jobs that were shed at the beginning of the pandemic were low productivity, face-to-face service type jobs. Okay, so that mechanically sort of boosts up this real output per hour work. But the other part, and again, we saw a little bit of a slowdown here, but still, where we're at now is much, much stronger, about 5 percentage points higher in level terms than where we were, the trend we were on pre-pandemic. So going forward, we have this sort of productivity tailwind pushing growth forward. Now, we can talk about some of the factors or some of the discrete changes that happen to the economy and the way that we work during the COVID period. One of them is this dramatic increase in paid working days at home or remotely. So the workforce, especially those at the upper end of the income distribution, they get a lot more flexibility in their day. They're able to more efficiently allocate their time. Commuting times went way down during this time period and still are well off kind of where they were pre-pandemic. The number of commuting hours individuals have on a given week is lower. There's also all these other, you can dig into the time use survey stuff and kind of scare yourself a little bit. So yeah, we get these commuting savings. We also see that people have cut back, way back, on the amount of time they spend grooming and getting ready for work. So you can think about showers and things like this. That's no good. And it turns out they use about 40% of that saved time doing more work. So that may be what we're seeing in the productivity trends. I know there's a lot of fun stuff about return to the office, a lot of things that if you ask me a question on, I'm totally going to punt. But in the air outside of what's happening to federal agencies, there's a lot of talk about return to the office at the moment. We engage in some of these surveys at the Atlanta Fed. One of them is a survey of business uncertainty. We ask a lot of questions about return to the office orders. We're not seeing a whole lot, okay? If anything, these return to the office orders for a typical firm in the economy, not named Amazon, but a typical firm that doesn't want to shed their workers, a typical firm, okay? That typical firm, if anything, the return to the office order is just to reinforce the current suggestion about what the hybrid policy ought to be. Okay, so we don't see this dramatic shift over the next 12 months in terms of firms bringing their workers back fully in person 5 days a week. And we have some fun stuff. This is going to come out probably at the end of the month, maybe the beginning of next month, after the next FOMC cycle. But we've been asking these questions not only about your return to the office plans over the next year, but also if we suffer a really negative economic shock. So if the unemployment rate were to double, we entered into a recession, would that change your view on this return to the office? And for a broad majority, the answer is no. I thought that was kind of interesting because I kind of thought as soon as firms thought that they had a lot more power over the labor force, like the power dynamic shifted back to sort of more normal times, firm managers would be like, all right, we need everybody back. I think in broad strokes, we haven't seen a lot of this. And I think it speaks to the amount of additional work that these individuals are doing at home and how successful this sort of forced experiment has been. The other thing that could be driving some of this productivity growth is we saw this surge in business applications during the pandemic. Now, you might be thinking, oh yeah, I know what that surge was. It was a bunch of these Etsy shops because folks were kind of stuck at home and they were like knitting now, right? No, this is high propensity business applications. These are applications for an EIN with an intent to hire a worker within a year. Okay, so these actually tend to turn, a much larger share of these end up becoming viable firms, at least in the short run. And we all know that the young firms tend to die pretty quickly, but or a large share of young firms go out of business, but these are at least, they start. And this notion of kicking off like an innovation cycle with a lot of young firms coming on online, that plays heavily in sort of macro thought when we're thinking about creative destruction or we're thinking about knowledge dissemination. When you see things like this, usually see higher productivity growth trends following that. And the other possible sort of notion for why productivity growth is a little bit higher might just be AI. And now we're all using OpenAI, ChatGPT, all these other things. We've asked these questions in our business surveys. We see some broad, at least attempts at using these things, but low shares of workers actually engaging in AI uses regularly. That doesn't mean it's still not contributing to the potential surge in productivity. It's just that the penetration isn't super broad-based yet. And the question becomes then, when we see these huge transformative sort of innovations or new technologies, you can think, go back at the late 1800s, early 1900s with the introduction of the semiconductor. You can think about the internet, the iPhone, all these things. It usually takes a long period of time for that between the introduction of that new technology and when we actually see a bunch of people adopt it and it impact productivity growth. The semiconductor is anywhere between 30 and 40 years. The internet, 20 to 30 years. iPhone, again, 20 to 30 years, maybe 15 to 20 if you're squinting. And then here the question is whether or not we're kind of already there, because this is patent activity around AI, and we saw a lot of this kind of pick up in the early 2000s. So we might be on the cusp, or it might just starting to impact the economy at the moment. Okay, and we also are very clearly seeing AI drive investment in the US. So part of that strength in overall business fixed investment is tied to data centers. This then opens up a whole host of questions around energy usage and policies going forward that we don't really have fantastic answers for yet. Okay, the second known unknown, fiscal policy. Okay, if we moved on to the main course, you guys still working on salads? Okay, chew slowly. Okay, according to the CBO, everything I'm going to say here is according to the CBO. That'll keep me out of trouble. The share of public debt held by the public are these green bars. This orangish line is the deficit as a share of GDP. Okay? This share of GDP is on the right-hand axis. I think it averages a little north of 6% in deficit, 6% plus share of GDP in terms of deficits. As a result, the debt held by the public, which starts off right around 100% right now, rises to a little over 120% by the end of this forecast period, 2034. Next decade. Question?
Does that include the extension of TCGA?
No. No, it doesn't. So here are a couple of excerpts I pulled out of the report. You can feel free to read this. At least since 1930, deficits have not remained this large for more than 5 years in a row. And we're getting deficits of this size for the next decade. Since 1940, the first year the OMB reported such data, net outlays for interest, by the way, that's underpinning a lot of the deficit spend. Net outlays for interest has never exceeded 3.2% of GDP. It's doing so in every year in the forecast projection period. And then this scared the crap out of me. So I'm sharing it with you. As a share of GDP, debt is projected to reach 109% in 2028, and then rise to 122% in GDP by the end of 2034, 2.5 times its average over the past 50 years, and really darn high. Now, the folks at the CBO will also say, you may have heard some research that when the debt to GDP ratio gets right around 100% or so, economies tend to falter. That was based on some sort of fuzzy data, and when you correct the data, it's not clear that that's necessarily going to be a limiter. Okay? So you can point to examples like Japan that have debt to GDP ratios of right around 200%, and they're still doing reasonably okay. So it's not clear that there is any sort of threshold at which things would become a problem. But underneath those assumptions, and it was a good question, the provision of the Tax Cuts and Jobs Act is still scheduled to expire, so it doesn't incorporate that running along. And the other thing that's embedded in this is some pretty strong assumptions about population growth. And I want to talk about that next. But first, this is the thing that I get questions on this all the time. I'm going to preempt that just by saying I'm scratching my head too. When you see projections like that from the CBO, usually it suggests something that would be worrisome or troublesome about treasury markets going forward. You'd see that reflected in yields. They moved up a little bit today on the inflation data, but we're still within, I don't know, still the cleanest dirty shirt on the pile of laundry for now. Unfortunately, when that changes and folks completely incorporate what that debt load means, by the time every market participant has changed their mind, it's way the hell too late. All right, you guys starting to feel like the weather looks outside yet? No one's choked? Fantastic. Okay, immigration. So, again, leaning on the CBO here, this is their current projection for the non-institutionalized population in the economy. And we see this dramatic surge over the past few years. And I think you can see it pretty clearly here. and the demographic factors that contribute to population growth. So this light green is sort of net immigration. And you see this sort of pickup and surge over the last couple of years. That's something that our official statistics sort of miss. And it's something that, again, for anybody who's super wonky and into this stuff, this is like an incredible data exploration and analysis that some folks at the CBO did to kind of dig into stoppages at the southern border from the Border Patrol. They keep pretty good stats on folks that they stop, they arrest, and where those folks end up. So using that as a proxy, they're able to calculate the sort of likely surge in population growth due to net immigration. And the question then, I think, on everyone's mind is, sort of what happens now. We've seen the surge. We read the news, so we kind of know what's in the air. That surge was, I think, in my view, underpins a lot of what we saw in terms of strength of GDP growth, of aggregate demand. It also maybe kept a lid on wage growth over the last few years, especially in sectors like construction, leisure and hospitality, and manufacturing, other industries like that. And has sort of shifted out our sort of pool of labor supply. Okay, that's what happened over the last 3 years. What's going to happen over the coming years, it's not clear to me. And the thing that we're really wrestling with is which one of those impacts are going to be, what's the net sort of impact of kicking a bunch of folks out of the country? It's going to damage labor supply, which will likely put upward pressure on wages. That could lead to firms wanting to pass on higher prices, and then we get much higher inflation rates going forward. But it could very easily also damage aggregate demand, because the folks that are here and they're working, they're also spending. That spending enters into real GDP growth. It enters into the balance sheets of firms supporting the economy. And when you rustle up a large swath of the population and then they disappear, that does nasty things to firms' balance sheets and could potentially create some undesirable effects when it comes to what happens in the labor market and so on and so forth. It's not clear to me which one of those impacts wins when it comes to the sort of net position of inflation and full employment. Is that clear as mud? Good, because that's about how clear it is to me too. So I'm going to skip through this. Again, what we've seen over the past few years, I don't think this matters a whole lot for where we're headed. We've seen stronger than what we would think jobs numbers for the past multiple years. Right now, under our previous assumptions, without baking in this additional population growth, you'd anticipate seeing something on the order of 60 to 85K per month in net new jobs gained, and that would keep the unemployment rate constant. Okay? Right now, we're getting about 100K more than that, keeping the unemployment rate constant. Going forward, if in fact there is a large effort to round up some folks, digging into these signals is going to be a bit challenging. It's not going to be clear, to me at least, whether or not a decline in employment growth from here is reflective of a change in population growth or a change in the underlying strength of the economy. I'll be looking at other sort of factors. We can talk about those later if you want. Oh, here's a cool Border Patrol apprehensions and removal data. Yeah, I think that's all I want to say about that. We already talked about which sectors are likely to be impacted directly. Okay, the fun one, because we have some information, sort of, kind of, on this. But first, and I think this is starting to get reflected in the sort of media consensus. We've seen this dramatic increase in policy uncertainty, trade policy uncertainty in particular, over the last couple of months. This is, by the way, this is the trade war and tariff period from 2018 to 2019, just to give you a gauge of kind of how salient this trade policy uncertainty is in the moment. But you can kind of, and this is a proxy, I wouldn't put a lot of weight on this, but you can kind of feed these into econometric models of the economy and see how much uncertainty matters for, say, investment and growth. This tends to take about a percentage point plus off of growth, this sort of uncertainty. And it's a huge amount of uncertainty. It's 4 or 5 standard deviations higher than the sort of normal. Now, whether or not that's a great estimate, I mean, it's neither here nor there. But what we are hearing from firms when we chat with them directly is that this is creating a lot of confusion for them. And it's creating an environment that is sort of more or less risk off. Like, hey, I don't know how things are going to shake out. There's an increased option value basically when you have heightened uncertainty. So, you know, sitting on the sidelines and waiting for things to shake out is usually a good strategy. Yes, question?
Did the 18 and 19 uncertainty take the economic growth off the table?
Yeah, it's hard to run. So this is why it's neither here nor there. The counterfactuals are hard. We saw in our surveys, we saw it tamp down on investment growth over the time period.
They're not economic.
That would have fed through into GDP growth. So it would have likely, I mean, our economic models would say that we would have got much stronger GDP growth in 2018, 2019. Those counterfactuals are hard because they're based on some really strong assumptions. I would just say that on net, it was probably not so great for investment.
You sound like you're certain that today, that spike today, will lead to lower economic growth.
Crap. I do not want to give the impression that I have any certainty about what's going on. No, fantastic. I was just trying to point out that the magnitude here is pretty darn large. And I would just point out that we are hearing stories that sound like this is going to feed through into damage to investment.
Maybe projection.
Yeah, sure, totally. Everything that I'm going to say is wild conjecture and hearsay. Absolutely. So when everyone leaves this, they're like, okay, we don't want to invite that guy back anymore. Fantastic, that's fine. But at least you won't be able to say, oh, he said X, Y, and Z. And, you know, that's different than what we got. You're not getting that out of me today. I think you did a couple of years ago. You're not doing that again today. Now is not the time for me to get into trouble. Okay, I thought we'd have an answer to the first question by now. We have a kind of partial answer-ish. These are all the sort of set of questions that we have. Will tariffs be imposed? And if so, on whom and what? We kind of know a little bit of that, we think, at the moment, sort of. The big thing when it comes to the likely trajectory of the economy is what the sort of reaction to those will be. Will there be any sort of reaction from our other countries on exported U.S. goods? And then, so let me stop here. So a lot of people tend to, all right, here's something you can take. I mean this. All right, this is not just BS. A lot of folks think that tariffs are de facto inflationary, okay? They say, oh, an increase in tariff is going to lead to higher inflation. That's not true. Okay, and it has to do with a misunderstanding about what the definition of inflation actually is and what these things are, okay? So these are taxes on imported goods. They're levied on the importer, and who ultimately pays that tax is a question that gets kind of sorted out through how firms react and customers react. But the importing firm is levied the tax, they could pay it, they could pass it on to their customer, or they could ask for some sort of concession from the manufacturer, okay? But that tax in and of itself, let's say it gets passed through 100% onto the consumer, and we actually see what happens in the consumer price index. That's not inflation. That's a relative price change. That's an increase in the relative prices of imported goods. And unless that's met with some sort of further accommodation either by the monetary authority or the fiscal authority, that creates a set of painful trade-offs for households, and that likely means that there are price changes elsewhere in the basket that offset this, okay? Not inflation. Is it gonna look like it in the short run? Yeah, but that's an increase in the cost of living. And I know it sounds like I'm talking out of both sides of my mouth. I do that a lot, I'm sorry, but that's an increase, that's a real phenomenon when you change prices like that. That's tantamount to that's tantamount to the sort of bird flu thing, right? That's damage to egg production and chicken production that raises the relative price of eggs and chicken, okay? That's a real phenomenon. And when I say relative prices, I mean the prices of those items relative to all the other prices in the consumer basket, okay? And again, without further sort of accommodation, either from the fiscal or monetary authority, those sorts of things show up in the consumer price index, but then wash out pretty darn quickly. So you can think of tariffs as a sort of one-time level shift in the cost of living due to an increase in imported goods, prices of imported goods. Okay? That, I feel, you can tell this to all your friends and relatives. Please go do that. I would actually appreciate it. That's the only thing you're going to get out of me. That's an approximation of an answer. Any questions on that point? Yes? I'll go here and then come here.
Gradual tariffs, that, like Secretary of Treasury Bessonette suggested, would not meet this criteria, right?
I'm sorry, gradual tariffs?
Gradual increase
like a
in
stepwise
tariffs.
function in tariffs?
Right.
The way it's going to show up in the increase in the relative price is just going to be gradual, not one-off.
So that
Fine.
would be,
It's still a relative price change. It's not inflation.
Oh.
It's going to show up as an increase. So especially if you do meet this out over time, it's going to show up in the short run as an increase in the consumer price index, as an increase in the cost of living. That's not an increase in inflation. Okay, those are two different concepts. One, the cost of living is related to the standard of maintaining sort of a constant well-being, set of well-being, or you can think about it in the CPI, a constant set of goods and services. Okay, inflation has to do with the erosion of the purchasing power of money over time. Okay, and that's a monetary phenomenon for the most part. I will, after the 2021-2022 period, I will allow this sort of fiscal theory stuff too. So it could be a fiscal issue too that monetary authorities, don't snuff out completely. Okay? Good question. Yeah.
So with the price increase that you were talking about that are in the basket, like trade prices, that's been.
Well, think about, all right.
That shouldn't be considered as a question.
No, absolutely not. No. And this is, so if I do nothing in here today other than this is fantastic. Economists themselves actually engage in shorthand, which is really unfortunate for the general public. So they'll say, you're recording, they'll say stupid things like increase in egg inflation, food inflation, gasoline inflation, name an item, coffee inflation. That's all they're talking about relative price changes. They're talking about a specific item in the basket and its price relative to the others in the basket. They're not talking about inflation itself, which is an increase in the general prices due to a mismatch between the quantity of money supplied and demanded in the economy.
So would that be an increase in the basket?
Yes, and it usually happens over, the medium run. Okay? And we can talk about dynamics for how we get there. Those are great questions. It'll bore the hell out of some of you. You'll need more coffee. But no, absolutely. So, all right, so this is probably not the right audience to talk about this, but how many people All right, hell, I'll ask it just for fun. How many people have purchased less eggs because of the bird flu and the price of a dozen eggs? All right, we got one. Thanks for playing along. I'm betting most of the people in this room, you know, if they don't do DoorDash or whatever it is, Instacart, they have no idea what's going on with the price of eggs. They're really freaking high, by the way, right now. When I chat with households, yeah, they cut back. Most households, especially those at the middle to lower end of the income distribution, cut back a hell of a lot. Okay, that's a real phenomenon. That has nothing to do with general inflation. Because general inflation impacts all prices in the economy, and over, you know, the medium run impacts their wages as well. Okay? These are causing painful trade-offs. Tariffs will cause painful trade-offs for households. How they respond this time is going to be crucial to figuring out the forward trajectory of the economy. Okay? And I don't know how they're going to respond this time. My conjecture, speculation, is that they're on less solid footing than they were in 2018, 2019. After a very long expansion that that we saw a dramatic uptake in folks engaging in the labor force in productive ways across a lot of different demographic factors, and household balance sheets were super strong in 2018, 2019. I think for the lower half of the income distribution right now, we're not in that world. We're in a world where they're struggling with the high prices at the grocery store. They're struggling with high interest rates too. This is kind of a double whammy. It's not fair, it's not fun, but they're not doing well. And they're saying, we can see this in the micro data, in the credit card spending data, in their saving data. It's already starting to hurt, and we haven't even seen, you know, this next sort of, you know, hit over the top of that. Yeah?
So it sounds like, so based on my understanding, so the tariff is a one-time shock on the prices gross. It shouldn't impact longer-term inflation projection.
Correct.
But why, like, right now people are lifting the inflation projection and expecting Fed to slow the rate cuts?
Sure. So one thing that happened this morning was that the CPI was a hell of a lot hotter than anybody kind of thought. And I spent some time digging through that this morning. I was going to talk about that a little later, but there are two things. One, if you dug into this morning's report, this is before any of this sort of inflation stuff, so maybe you could tell me some sort of time inconsistency story, some sort of firms anticipated tariff changes, so raise prices on consumers now in advance, just to make sure they didn't lose out on margin. I don't know if I buy that story, given how much uncertainty there is on which countries are actually going to get hit and which industries are going to get hit, whether or not there's exemptions or all that. Like, we don't know. But we saw a relatively broad-based uptick in inflation. If you were an inflation optimist, which I know this is going to sound really funny, I actually kind of am, or was until 8:35 this morning. You would point out that January, at least, especially since the onset of the COVID pandemic, it tends to be a weird month. It tends to be a month that is much higher than the average over the remainder of the year. We call that residual seasonality. It's a little bit wonky, but these data have already been seasonally adjusted. But here's a pattern that remains after seasonal adjustment. So that's one reason why you might say, okay, I don't know if I buy this yet. And then again, this is super wonky and I'm sorry, but if you dig through the underlying detail, there were a lot of spikes in disparate areas. So we saw a pickup in autos, we saw a pickup in medical care commodities, we saw the Netflix surcharge increase, that fed through. So we saw all these really wild price increases. So like over the last, and in fact I'm going to show this picture here in a minute, but over the last maybe 3 months or so, right around 20% of the consumer market basket has been exhibiting price increases greater than 5%. This month it was more like 60. That to me seems weird. I'm just going to call that a weird. So I don't know how much, I how much of my confidence in sort of the trajectory of inflation I want to place on January's data. I want to see what happens. Actually, I want to see what happens in April, because there's still some question about February month. But nonetheless, all right. I'm kind of getting off topic. Let me jump in. Any other questions? Those are good questions, though. Yes.
Yeah, my question is about policy response. The view within the Fed is that the impact of tariffs is impact of one-time change in prices. Is it fair to believe that the Fed won't respond to those changes in prices?
Okay, so this is a good question. So the question is, so if the rest of your colleagues thought the way that you did, that this is a one-time level shift, this is a relative price change, would the Fed be willing to sort of look through this? Fair? Okay, great question. I can't speak for the rest of those folks. I can hint at it, but I can't speak for them directly. And I'm going to hint at it out of both sides of my mouth just to keep you guys on your toes. Okay, I'm going to show you a slide, if I get time, about what Jay Powell sort of said coming out of the last FOMC meeting, and I believe he said it yesterday and is saying it again today, about the need for patience. Okay, well, we haven't seen how any of these known unknowns are going to play out at the moment. It's probably a good time to take a pause and see how things flesh out and see how they truly impact the economy before the Fed decides to respond. Okay, that's his words, paraphrased more or less. The other thing I would say is whatever sort of faith you had in that response should be tempered by what happened during the 2021-2022 period. So we started out with these things that were transitory, these supply chain and shipping constraint impacts on prices in the economy. And those ended up feeding through into broad-based inflation. Now, my answer for how that happened has a hell of a lot to do with how much fiscal and monetary support there was in the economy at the time. That actually, I think, exacerbated a lot of those shipping bottlenecks and supply chain constraints. So the money growth in the economy was north of 25% on a year-over-year basis in 2021. After March of 2021, you guys know what happened then. And a bunch of people were sitting on cash, the amount of cash that they hadn't been sitting on in a lot of times. I know anecdotally from folks like my mom, burns a hole in their pocket and they go nuts. They're buying Pelotons and pandemic puppies and gym equipment for their garages because they're sticking home for a while, right? Well, guess what that does? That increases the demand for imported goods, and it did so at a time where supply chains were just in complete disarray. So that sort of impetus has nowhere to go but into price, because it can't change quantity, okay? That's an example of what I was talking about earlier when I was saying, listen, unless you see some sort of additional support for households monetarily in light of what's happening with these tariffs, if you see something like that, like there's checks distributed out to households or monetary policy responds in a way that creates a lot more accommodation, I don't think this becomes inflation, okay? I don't think it feeds through into firms going, well, I'm passing all of this on, and this is gonna be super inflationary. I think it actually just damages real output, and it's not so good. In my view, mine alone. Still have most of you? All right. We're almost done. All right, so I talked a little bit about inflation. Progress, even before this morning's report, had stalled, I think, and sort of near-term trajectories, and you can see this in the 3-month, really choppy, but hanging out around 2.4%. A little bit higher than 2. We needed a 2. And you saw a lot of strength in this, what folks in the news media are calling super core. This is core services ex housing. There's some funky things happening with housing. there was all this stuff happening with goods, and folks were like, listen, this is a durable, sort of sticky part of inflation. We ought to pay attention to this for signals of what's going to happen in the future. And this has remained elevated relative to where it was pre-pandemic, right around 3.5%. And then this morning's report, annualized rate, I think, was close to 7. Not great. I'm hoping it's a sort of one-off seasonal mismeasurement issue. I don't know yet. I gotta crunch it.
What's the next measure?
Second week of March, and then we'll start to try. And then the next thing would be, the next thing that if you get an economist as a speaker, it'll start to be like how quickly are tariffs sort of feeding through, and then they'll come back to that pass-through question. So that's one of the things that we're going to start to ask we run a bunch of business surveys. We're asking that question as soon as these things start hitting in mass. Because that's going to be, I'm sorry?
What was that number today from the prior
Oh,
slide?
yeah, so this is the personal consumption expenditures pricing.
From the prior slide.
Oh, I'm sorry.
Today's report. I've not seen it, so tell me what that number is.
Yeah, so this is from PCE, so it's
okay.
a person, but they're very analogous, right? The CPI tends to run a little bit hotter, but that number today on an annualized basis was 7.1% or something ridiculous like that. Okay, more than double sort of the 3-month trailing annualized average was I think 3.6%. Okay, so like double. Scary double. Maybe. Okay, so this is, I talked a little bit about this. So we had started to see this, so this is this high inflation surge period where about more than half of the market prices were rising at outsized rates, at rates in excess of 5%. That's been slowing over the course of 2023 and 2024. We had gotten back down to a sort of like close enough for government work, looking pretty good, normal-ish. This morning, it jumped back up. I don't know how to factor that in yet. I haven't spent enough time in thinking about how much of what we saw today was noise versus signal. I will say that if I go and look at the share of the basket with excess, so rates rising at greater than 3%, so this is like thinking about in between 3 and 5 sort of, that's been elevated. And that's still a little bit elevated. So what are we doing? Okay, so the Fed a couple of weeks ago lowered rates into the range between 4.25% and 4.5%. And I've highlighted from Jay's statement on January 29th, conditions seem to be broadly in balance, at least to date. Moderately restrictive or restrictive enough in the committee's view. And then here, I think, is the sort of key message for today. We're going to be kind of waiting to see how everything shakes out. Okay? We need to see how these policies are going to be articulated, what the uptake's going to look like, what the response for actors in the economy is going to be before we can give you a plausible assessment of how that's going to impact the Fed's view of economic conditions and inflation going forward. Said another way, in a way that won't get me into trouble, does anybody see what market participants' views on the next Fed funds rate cut would be after the inflation report this morning?
September.
Not even, not anymore. Not in 2025. Okay? And my dartboard says that sounds about right. I mean, it's literally going to take time to figure everything out. Time that, it might be painful, but in my view, folks are going to have to kind of be patient, see how it shakes out. I think, yeah, go ahead.
There's sort of evidence for a second wave, usually probably the first wave, which
Is this a Torsten Slot stuff?
no.
Okay, so somebody had this really clever picture, and I thought it was Torsten, where he layered on or superimposed today's sort of inflation dynamics, the last like 5 years or so, over what happened in the 80s, 70s and 80s. And you saw this sort of notion that maybe there was this sort of second wave or rebound. I will answer that question. That's a really cool picture. It's neat. I don't know if I buy the result there, but I will say this, that prices in the economy, some prices in particular, are very sticky and slow to adjust to changing economic conditions. One thing that you see, and that we've seen over the past few 6 to 12 months, are some areas where they're incredibly sticky, like insurance prices. Those have been really elevated. They're sort of playing catch up. So that sort of differential price stickiness might actually be this sort of notion of, be connected to this notion of this second wave-ish, I think. Or just that they're slow to respond, so then the overall aggregate looks higher than what it would if everything responded all at once. Clear?
Yeah, the other idea I've heard is the lagging labor response driving this.
I'd have to think about that, but I don't think I showed you too much in the terms of wage growth today, but those are actually looking pretty solid, pretty decent. Back down in the sort of range of pre-pandemic levels, and expectations from businesses that have actually been pretty solid over the last few years. Those are for further sort of slowing back to sort of normal. So I don't know. I'd have to really think through how that. I'm not so sure. Anything else? All right. Yeah.
I have a question for you. You mentioned you're an inflation optimist. So
I was until 8:35.
That's not my question. I wonder how that compares to your colleagues you in this room. Feel free to survey that after I'm done. But if things were going to move the wrong direction, causing you to be an inflation neutralist or pessimist, what would be the sort of three different factors?
Yeah, fantastic question. So let me start by saying why I was an optimist. I might still be an optimist, but why I was. Again, you heard my views on what inflation is and isn't. So then it becomes, the exercise becomes incumbent on your ability to disentangle noise from signal in the underlying inflation statistics. So we have some very simple techniques to do that. Those techniques were telling us things were getting close to neutral, or close to 2%-ish, but there's one particular component in the price change distribution that's a problem, and it's rents. And in fact, it's owner's equivalent rent. I will just say it's like an approximation for what would happen if everybody in this room decided that they were gonna rent their house and they were gonna put their house on the market for rent and go rent somebody else's house instead of living in their own. That's basically what owner's equivalent rent is. It's a measure of housing services prices based on nearby rentals. That thing used to predictably lag market rents by about a year or so. That relationship over the last 3-4 years has kind of fallen apart a little bit. That lag is much longer than what it used to be for reasons that I don't understand yet. But if you plugged in market-based rents or some forecast of market-based rents based on the previous, or some forecast for OER based on the relationship it used to have with market-based rents, you'd get an inflation rate right now that is about 1.8%, okay? And then the reason that I was really optimistic, so one, I thought we were home free, and then two, when I survey firms' inflation expectations, and I don't mean their overall inflation in general or CPI expectations. I don't think real people other than economists have like good, well-formed views on these things. When we survey their unit cost expectations, or their own firm price expectations, or their wage expectations, and then aggregate these things up, all of those trends are positive. All of those trends are back down to sort of normal. Now, what's going to happen over the next 6 months or so? I hope you know that I am at least as clueless about what's going to happen as everybody in this room, probably more so, because I'm not chatting with folks on a day in, day out basis. So, I mean, at least up until today, I was optimistic. Today, I gotta figure out how much of that January was like residual seasonality or some sort of mismeasurement issue. I will probably convince myself of that because I don't see evidence in expectations that are getting away from us yet, but that will be the thing that I'll be looking for over the next 3 to 6 months as all these policies come out. Yeah, I guess I'll stop there. Anyway, yep, go in the
Yeah,
back.
I mean, not to go back to this tariff and aggregate price level.
Sure.
I mean, those businesses you survey, right? If they start to worry about tariffs,
Yep.
do you think their inflation expectations will change over the next 6 months?
Yeah, so that's what I'm going to look for, right?
Yeah.
So right now, I think what do we have? We have the sort of steel tariffs. We have some things that have been bandied about with Canada and Mexico, and then sort of put on pause. I have no idea what's going to happen with that. But even, let's assume everything that's been talked about goes through, okay? The two things I'm going to look for in particular are what are firms going to do? How much of this are they going to pass on? Anybody who's directly impacted, how much of that increased tax are they passing on to their customer, be it business to business space or business to consumers? Okay, that's number one, because then that'll give me a rough direct estimate of what I'm likely to see on the price side. And two, I'm going to look and see how much purchasing power or pricing power firms not directly impacted tell me that they have. And I'm going to ask it in that way because I don't want to ask, hey, is all this tariff noise going to give you coverage to increase your prices because everybody kind of expects price increases? Okay, I don't want to ask that directly. That's kind of a terrible thing to do. But I'll ask about pricing power. And if they tell me, oh yeah, I have more pricing power now than I did 6 months ago, I'm going to start getting nervous. And then I want to see what their long-run cost expectations are going to be. Okay? And that's, if I start to see those rise up again, like we saw in late 2021, yeah, I'm going to switch to being a pessimist pretty damn quickly. That's a good question. There's one more up here.
Yeah, so the price level is 25, 30% higher than it was in 2000.
Correct.
We're still increasing at 2, 3, 4%, whatever that number is.
2.5.
Do you see us ever getting back to the 2000 level? 2000
Of prices?
Price level.
Oh, fantastic question.
And how do we get there?
Well, so I don't think anybody in this room wants us to get there. In fact, nobody in the country really wants us to get there. Why do I say that? Well, so in order to get the price level down to where it was in 2019, what do you need to see? You see deflation on the order of what, 30%? Yeah, does anybody know when that happened last time in the US?
Recession?
Yeah, I don't want that to happen. Like that's bad, that's a bad news. You don't want prices to ever go back there.
You get lower mortgage rates.
You'll get fewer folks in the economy that can actually buy a damn house. I mean, like that. I'm not trying to be flip, but that fundamentally that would be really, really bad. That would be a really bad outcome, and that'd be a series of huge policy blunders to get us to a situation where the price level is back down to 2019. Okay. What we would like to see going forward is something that roughly gives us about 2%, increases in the price level of about 2% on average in perpetuity. That's where we want to get. So we never really want to get back to 2019. Yes?
So to that question though, isn't it the case that when you compare the wages pre-2020 and the purchasing power,
Sure.
the cost of goods and services and where the wages are now,
They're actually pretty
They're actually
damn
pretty-
close.
they're
They're
pretty
pretty.
close.
They're pretty damn close.
so
Because
in real terms, there
Yes.
isn't inflation because your wages
No.
have gone up too.
no. In real terms, people's relative wages, their real wages, are about where they were.
Yeah.
Okay?
Yeah.
So we've seen real wage growth over this time period. We saw a period where real wages lagged. So there was a decline in real wages. But then that came back. And it didn't come back in a huge surge, but it's been coming back over time. And we're pretty much in line in terms of real wages. They've come back. And that actually is part of the inflation process. Okay, if it truly is inflation, wages respond. Now, wages are sticky, they respond a bit with a lag, but they should respond to in a commensurate way that with what you see in a market basket prices. Here first, yes.
Why is the targeted desired inflation positive?
Why is it positive?
And not zero?
That's great. Why is the inflation target not zero? I love this question. There are two components of this question. One is in the price statistics we use to measure inflation, they're actually biased, and they're biased upwards in terms of how much substitution really occurs in the economy relative to what they're able to measure in these indexes. It's about on the order of 3/4 to a percentage. So if you wanted to target true underlying inflation rate of 0, you would want to target measured inflation rates of about 3/4 to a percentage point, okay? So that's that first part. The second part is a little bit of a buffer to keep us from situations where we would get deflation. That's a very simple way to explain it. And if you go back in time and look in history, especially over the last expansion, we didn't quite get to 2, but it was like 1 3/4, 1.7%, pretty close to 2. Did anybody care about inflation? No one even knew what it was then at all. It was great, it was beautiful, halcyon days. That's what we want to get back to. I think the problem is we saw this 25, 30, I think 32% rise in inflation over a very short time period, and that creates a lot of pain, even psychologically. And consumers are sitting there going, they're paying like $11 for a carton of eggs now, and they're like, it used to be $2.99, what the hell? And they're mad, they're angry about it. You can see this reflected in their sentiment figures. And I think it's just that inflationary surge that we saw is the highest we've experienced in this economy in 40 years, and it leaves an imprint. And it's going to be a bit of a lasting imprint. But yeah, so my hope is that inflation starts to recede into the background, and then slowly people forget about 2019.
A lot of people are always talking about right tail risk on inflation. Not many people are talking about left tail risk on inflation that stems potentially from a consumer that you're saying is a little bit struggling, and potential implications of government policy that is trying to reduce spending with the economy that's very much tied to government spending, and how that impacts people's psychology in terms of the way they spend for the rest of this year or next. So, is there any thought on how employment within the government sector or sectors related to government spending can be impacted from deficit reduction, and how that can impact consumer confidence or business confidence? I know that was a lot, sorry.
No, that was more than most. I'd really have to think about that question in a meaningful way to give you a good answer. And because it talks a little bit about potential changes in government employee levels, I'm going to punt for now. And maybe next time you can ask that question, and we'll be in a different situation, and I'll have a good answer for you. But that was a good question. All right, I want to get the hell out of here before anybody else asks me anything else. All right, thanks so much.